Okay, it looks like we've got a quorum here. Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Vince Piazza joining from somewhere along the Northeast corridor, swinging down to Miami. We've got Mike McGlone. And also, we've got guest Alessio Mastrandrea joining. Alessio is normally based in London, but also is joining from looks like an undisclosed location in New Jersey. So with that, we're going to kick off and let's just do a quick commodity check-in. It looks like oil market's a little bit excited here at the moment. It looks like an up day. Brent looks hovering around mid 70s, and perhaps some sentiment from the conflict in the Middle East is swaying things a little bit here at the moment. But Mike, you've got a provocative call on the market and have had that for some time. I believe you've got a note out that just this morning that talks about a crude bounce. So tell us about your thinking on where we stand in terms of the overall commodity landscape here at the moment.
Hey, Rob, I love that word provocative. It's a lesson we don't learn in research. We can like the best research in the world, but there's a lot of competition. So if we don't have good headlines, we ain't getting clicks. And unfortunately, that's just part of the business. But the clicks are, everything is about facts. The fact is crude oil is clearly in a bear market. It's clearly oversold. And it's definitely bouncing. So right now it's sharply unchanged on the year, depending if you're looking at Brent or TI, they're about unchanged in there. And they've had good reason to bounce as we see missiles flying on CNBC, Bloomberg, and CNN, my screen's in front of me, in the Middle East. So that's a good reason to bounce. But the key question is it going to have any type of curtailment of supply? And is it doing anything to demand? Anything I'd like to point out, I've been pointing out for months, it's still the bearish factor. So in the big picture, I still think WTI is going to do kind of what natural gas did, what iron ore did, what the grains have done. You see the trickle down, and it has to get cheap. And that to me means $40 a barrel at some point. But right now, it's so sold out. I mean, we've never seen managed money net positions on petroleum positions going back, what we got, almost 11 years. This sold out. Brent actually got short a few weeks ago, and it's bouncing as it should. But what's been happening is the migration in broad commodities. Massive profits in the grains, being short for over a year. They took profits. There's been big short covering for the last few months and boosting those prices a little bit. But harvest is starting to kick in, and it's the biggest on record in the U.S. So there's a pressure factor there. We've had natural gas has plunged. Why? Because there's just too much supply of it, and the demand is not picking up as much as possible. So bottom line for me is, I look at the macros. Gold's up 45% on a one-year basis. TI is down 20% on a one-year basis. Remember, it was right in the beginning of October last year when it peaked with the 10-year note right around 5%, and now it's below 4%. So it's a whole macro to me for commodities is, yes, they should bounce. Gold is leading the way, is not good. And I'll end with this. The bottom line for me is a rock beating stocks is not a good indication. So I just point out gold up 45% on a one-year basis. That's 10% more than the S&P 5 total return. It's what we look at for a year from now. And the bottom line for me for everything in commodities is the stock market has to stay elevated, for copper to stay up, for crude oil to stay up, or gold's going to continue to beat. And in the macro and for crude oil, it's just, we all see now the trends in supply and demand elasticity are showing they're more powerful than ever. And the oversupply versus lack of demand, most notably from China, is probably not going to change a lot as we get to a year from now.
Okay, fascinating, Mike. Vince, let's swing over to you. I'm curious to get your pulse on the oil market, and I'll also just note Henry Hub gas is just flirting with $3 per MMBTU here at the moment. So let's get your take on gas as well.
Yeah, sure. Why don't we start off with natural gas? So, despite the fact that we've had a very mild demand in this early autumn period, we are seeing gas spike. It's up 18% year to date. And if you look at the production side, our thesis has been production growth will slow. We have seen that across the month of September. We are well below 100 BCF a day. So the discipline that we talked about on your show and in some of the work that we've written, including our focus idea, the discipline has held. Now we're seeing pushing closer to $3 during this period of what we call the shoulder season, in between the summer and the winter. And also, by the way, Rob, storage is roughly 6% below last year. So we are definitely tightening. Balances are tightening. We're looking a lot better heading into the winter season. Our estimate for gas and storage of around 4 TCF is coming very close. If the trends maintain over the next 6 weeks, 6 to 8 weeks, we'll likely see that number hit. So we're looking pretty good. We just need that to get closer to our 350 prognostication for prices ahead of winter, and hopefully we'll get there. On the oil side, look, a lot of geopolitics at play here. And I'm just going to toss off my hands and say, look, for the U.S. guys, they still maintain that discipline, similar to the gas guys. The focus here is on free cash flow. Every investor I talk about wants to better understand free cash flow yields as opposed to production growth and reserve growth. So investors still with that value-centric mindset, looking at cash return, either via dividend or buyback.
Great. Thank you, Vince. For anyone who doesn't know how to find it, you can type BI space focus and go find all of our focus ideas. So Vince mentioned his focus idea on natural gas. That's where they all live, and way more than just energy stuff there, but along the top, you'll see the ability to filter for just the energy ones, if that's your thing. Alessio, let's come over to you. I want to tie you into the commodity conversation. Mike McGlone mentioned some challenges in China. I'm curious because China is a big player in the solar space generally. And so I know we tend to focus a little bit more on the sort of fossil fuel commodity complex, but let's get you to unpack a little bit what's been going on with polysilicon, key input for the solar industry, key commodity there, and what's it meant for module prices.
Thanks, Rob. Yeah, sure. So polysilicon prices are nearly at all-time lows. They're trading at about $4.60 a kilo. A year ago, that was closer to $9.20. So it's down about 50% over the last year and down closer to 90% over the last 10 years. And a lot of that is because of oversupply in China. Like you were saying, China is a key player in this space. They produce between 80 to 90% of all the world's polysilicon. And if you kind of zoom out and see like polysilicon produced in Korea or Germany or the US, that's closer to about $20 a kilo, but it's a very small share of that pie. Over to module prices, even those are close to all-time lows. I think they're trading at 9.6 cents per watt. Just to give you an idea of what a Chinese module versus a US module costs, that's the price mostly in China. First Solar sells their modules closer to about 30 cents a watt.
All right, thank you, Alessio. Mike, I want to swing back over to you and just hit a little bit more on the idea of China, because I think it's a factor in not just energy commodities, but also materials as well. You've got a note out from just the other day comparing and contrasting what's going on with crude and copper. Your headline says they both look vulnerable. So I'm kind of curious to get a bit more of your thesis. And I will just add one more thing. You can go to Mike's bio Mike McGlone, look him up. You can subscribe to his research. You've also got a note that says crude, $40 in 2025 versus $10 in 1986 and 1998. What's the difference? So tie us into that sort of China story and then bring us back to where you see crude over the course of the next 12, 18 months.
So I appreciate. Let's start with China. I started developing my reversion views on China over a decade ago when I first visited Shanghai and Hong Kong. And having worked for Japanese firms, those of us who remember IBJ, decades ago. We've seen this before. A lot of us have. So what we're seeing in China right now is just a normal reversion of a rapidly emerging market. They made the mistake of being a decisive enabler of a war in its best customer's backyard. Now that's just a fact from NATO. I'm just pointing out facts, and this is what's happening to me in China. So what you'd expect in that environment is stimulus, and they're getting stimulus. But the fact that the commodity market has to depend on stimulus from China, has to depend on complete discipline of more cuts from OPEC is part of the problem in commodities. What they always do is they get cheap after getting expensive. And that's going back and measuring from 100 years, and particularly the Bloomberg Commodity Index since 1960. It's a question of what stops that process. So to me, the bottom line for all commodities is a normal reversion process in China. We're seeing that every day. Just look at automotive manufacturers in Germany, just getting started. We see recession tilts there everywhere. We see the cutting rates, which you see. And the question is what stops it? Now, we should see bumps in the road. Obviously, the HSI got very cheap versus its 60-month moving average just a year ago was the lowest in, 30 years? And Chinese are doing just what the Japanese have been doing since 2010, is buying equities through ETFs, completely predicted by Eric Balchunas and our ETF strategists. So that's expected. But key thing I like to watch is you can't, and also it's a very autocratic rule. You can't really trust their data anymore. It's really one person, but just can't mess with math. The Chinese government 10-year note at 2.21%, to me, is where I think all bond yields are going. Now, Germany's catching up. They're just about where Japan has been for so long, and it's just a matter of time the U.S. tilts there. What stops that? And the number one thing to stop that is you need the U.S. stock market to stay resilient, but that might be a problem. But the key thing, I think, from China to look forward to is expect more stimulus, but it's on the back of distress and disdain and rising unemployment and macro trends that are virtually unstoppable. The housing market, and what I've had to do is go back and read a dozen books, and maybe a dozen books, on how expensive it was. The last I heard, it's still worth about $60 trillion, which is way overweight on GDP, and it's just starting to revert. You look in NI China or BI China every day, you can see the facts of what's happening there based on the data we see. So to me, that's the number one factor in commodities, but also it's what Alessio, we can focus on, and you focus on too, is the overwhelming deflation coming from China in EVs, in renewables, and virtually anything to do with energy and substitutes for petroleum. And so the fact that most of the rest of the world has to impose tariffs shows where things are tilting and where is it stopped. So I view that as an overwhelming force. It's part of the reason I'm still bullish gold. Now, gold is getting expensive. And managed money net positions are way long. They're due for a little bit of bucking of that bull market. But then you look at all the broad commodities. The key thing I'll end with is copper is one I'm kind of focusing on now. Is copper's been bumping up against $10,000 a ton. But what's been driving copper this year? It's not organic demand pull out of China. It's been some supply constraints, most notably Panama, but most notably speculative futures. I mean, they got the most long to that peak at it was around 11,000 tons and 520 pounds in May. The longest as percentage open interest, like 32% in 4 years. And now they're pulling back a little bit, still way stretched long. So to me, as a commodity guy, I'm watching copper as my next key shoe to drop. Now, if it stays above $10,000 a ton, that's great. It's a good indication. To me, it's more likely to head towards 8,000 to 7,000 on a normal reversion. So crude oil's already kind of done what it's supposed to, and I still think it has a lot more downside. But I'll end with what I pointed out as far as crude is. I remember, those of us who remember a lot of these, but being a trader when Saddam Hussein invaded Kuwait, crude oil went from 20 to 40, and then by 1998 it was at 10. During the Iran-Iraq war is when futures first started trading. Crude oil went to 30, and then by 1986 it dropped to 10. So to me, 40 is the new 10. And since that peak at 40 in 79, 40 has been the pivot. And I think it will be. I continue to head. I think we got to get below that level to really do what Vince pointed out in natural gas. We got well below that 2 level, and it reset the market. I think you need to see that in crude oil, and we still aren't there.
Mike, let me just follow up quickly on the idea of copper. We totally need to get Grant Spoor, our head metals and mining analyst, on and hear his view on this, because it's been a while. He's joined in the past, and I know he's I think he probably would agree with some of your sentiment in the near term. But the thing that always comes up on copper is it's a key energy transition metal. We're doing all of this vehicle electrification, you need transformers, all just on down the line, all the stuff that happens potentially as we move to more wind, solar, batteries, EVs, all these kinds of things. And what do you make of that piece of the story? I think that's part of this sort of thesis that Jeff Curry has on copper. I think copper is one of his strong calls. At least the last time I saw him speak anywhere, he was really talking up copper.
Yes, and unfortunately for Jeff, oftentimes they bring him on when markets make new highs. He says his main piece, and then most traders sell and they go down. So the key thing about copper is here's a key fact. I expect copper to continue to outperform crude oil, particularly if you look at 2022, copper made a new high, crude oil didn't. This year, copper made a new high, crude oil didn't. In the big picture, you're absolutely right. But what you mentioned is a complete known. I mean, I literally hear it from children now about it's just one of those things that's so widely known in the market. You have to be careful. I'm enjoying the book right now called Material World by Ed Conway. And I'm on the copper section, which is good. We get it. I understand. It's, as far as electrification, you got to go to copper. The problem is the macro is so overwhelming. First of all, it has a very high correlation with bond yields. And if you overlay copper per pound price versus a US 10-year note, copper should be below $4. And right now it's at 4.62. Yeah, overall it should go higher, but it's a high correlation with the stock market and also very high negative correlation with the dollar. So copper's in between, but to me it's a macro that matters. Yields have to continue to revert, go up, and stock market goes higher, or copper's got a problem. It's going to revert like it always does. And I'll end with this. The price right now, 462, I think was first traded in 2007 or so. I don't have the chart up my screen, but it's a very mean reverting commodity, less so than crude oil, and it's very dependent on demand pull out of China. The doctor copper, and the bottom line, as I point out, the thing I'm really worried about is managed money net positions are way long. I mean, they're very bullish copper. But what you point on, big picture, absolutely. I just think you're going to more likely have a chance to buy it closer to 3 than above 5.
Okay, very interesting. Thanks a lot. Vince, I want to shift gears and kind of move away from the sort of macro commodity type discussion and hone into some company specific work that you've done. So we already chatted about your focus idea briefly on natty gas, but you've also got a focus idea specifically on Chesapeake and Southwestern. You updated that focus idea just the other day. So tell us about your thinking on that deal, what your focus idea is, and how you see that evolving.
Yeah, hey, thanks, guys. So not long ago, we put out a focus idea on the Chesapeake Southwestern deal. As many of you know, that deal was highlighted for concern because the FTC was looking at it quite extensively. They asked for a second set of data, second set of information from the two parties. The reason why this is such a crucial deal, it would create the largest independent natural gas producer in the U.S. Chesapeake Southwestern have extensive exposure in both the Marcellus and the Haynesville. And when we looked at merger arbitrage spreads, they really blew out on the call for additional information from the FTC. Our view was that you have a global commodity, and U.S. natural gas is produced not only in the Marcellus and in the Haynesville, but also across the U.S., in the Permian, in the Eagle Ford, all across the U.S. And so it is a fungible commodity. It goes where the best price exists. And so our focus idea centered around the fact that we thought that the review would not just focus on the exposure in the Marcellus and the Haynesville, but it would consider the global exposure of natural gas, since natural gas is a global commodity now that U.S. exports a fair amount of liquefied natural gas. And so late last week, the FTC declined to comment further. The comment period expired. And so this deal was allowed to close before year end, which was our thought. And I think what this does do, Rob, is it does set up a framework for future deals. in the nat gas space. We need more consolidation. We need fewer companies. We need larger companies, and we need more assets in stronger hands. Stronger hands, more disciplined hands. And I think this is the framework for future deals of this type.
Great, thank you. Vince, and I want to swing over to Alessio, switch gears to think about the wind space. It's interesting hearing you talk about consolidation and larger companies in the natty gas space. When you think about wind, you essentially have a oligopoly that really controls something like 70% of the market. It's highly concentrated. You don't have all of these sort of like independent mom and pop wind manufacturers. And so, Alessio, you've got a cool note out this morning, not specifically on the market share construct, but on how wind is potentially exposed to the idea of data centers and AI. For those who didn't see it, we had a deep dive out last month on the general topic of AI, data centers, and what it means for energy demand. But as you're probably familiar with BI, we don't just put out research and sort of put it on the shelf. We're always revisiting it as new information, new data, new ideas become available. So Alessio, let's come over to you. Talk a little bit about your note this morning. And I will say you also talked about the role that hydrogen could potentially play. So also give us a sense of what might be going on there.
Sure. Thanks, Rob. So we took a look at this slightly differently to the deep dive, where the deep dive focused on solar, batteries, and gas. We wanted to explore a bit how wind plays into this. So we looked at this from three pillars. One was government support, two was the cost of wind, and then three was the hydrogen piece. So in terms of government support, took a look at the Inflation Reduction Act, and I had a look at all the manufacturing facilities in the US since the Inflation Reduction Act passed. And what we found was 50% of them are actually in red states, which kind of gives a justification to our policy team's 10% risk of a repeal if Donald Trump wins the election. That's probably why it's likely lower, because he wouldn't want to maybe hurt his base who has jobs in these manufacturing sites. So the second piece is the cost piece. Looked at this from an LCOE angle. And onshore wind is actually the cheapest form of new electricity, even cheaper than solar in the US. So that's maybe a justification for Microsoft using wind as part of their data center needs, even though solar still might be the top source because it's 2 to 4 times faster to deploy. Wind is something to maybe consider part of that mix due to intermittency. And then lastly, took a look at hydrogen. Is hydrogen, wind's answer to battery storage? And the answer is likely probably not, at least not this decade. So the IEA put out they basically said that hydrogen fuel capacity will increase by 45 gigawatts through 2028 in their best case scenario. But even this time last year, that's a 35% cut to their forecast. So maybe not as super viable as battery storage is to solar.
Cool, thank you, Alessio. Can I do a quick check-in with you as well? I think one of the things we keep tabs on is the order intake, order backlog for the space, and I think Vestas has an update out here recently. So give us a sense of how did 3Q shape up for them? Are you seeing the idea of this stuff really translate into orders?
Sort of. So Vestas is off to a slightly slower start than it was this time last year. They did 3.7 gigawatts worth of orders in 3Q. They did 4.5 this time last year. So you might think that's a bit tepid, but if you're also looking at the trend from last year and the year before, Vestas' order book is generally very heavily weighted towards Q4. Last year, I think they did close to 8 gigawatts. So they are tracking to a similar year to last year, which then bolstered their order books.
Okay, fantastic. Since you mentioned policy, I will note that we had our vice presidential debate last night. I didn't watch all of it, but I caught some bits and bobs of it. And there was some discussion about energy policy, and particularly the Inflation Reduction Act. And Mike, I want to come over to you first and get a sense or read out from you. What do you think? Does the election really matter for commodities? Does it affect your view on kind of you've already shared your take on kind of how where you think the general commodity landscape would go. Is politics a marginal influence? Does it matter at all? Give us your read. Does the debate tell us anything meaningful about what we should be thinking of for this particular part of the market?
Well, I think what you said pre-recording was the debate was, only watched part of it, was civil. And that's only to be changed because of one human being, the ex-president. And I do think if he's reelected, that's very bad for crude oil prices. It's great for business. It's great for U.S. Deflationary forces. It's great for U.S. exporting more and more. The superabundance, as I like to call it, of energy and food in this country, which is a big difference from the last time the Fed started a significant easing cycle in 2007. Was the opposite. We are the biggest importer on the planet of crude oil. But so to me, it's the bottom line. It's a drill. So we all know that iteration is there. The thing is, I like to point out is I do have a strong conviction that we will have the first female president. I think that's going to mean, and I can dig in those details later, but that's just, I'll make my call. And I think that means more of the same. The thing is, I like to point out is U.S. became a predominant massive energy shifting from importer to exporter during the Obama administration, not during the Republican administration. And they've been considered, it's just how market narrative picks it out sometimes. What's happening to me is this significant paradigm shift in electrification, which obviously is good for copper, but 50% of all EV sales now in China or auto sales are EVs. And that process is more likely, obviously, to accelerate with a Harris administration, but it's organic. And that's a key thing I like to point out. One key book I read was The Price of Tomorrow by Jeff Booth, pointing out how technology is moving so fast. It's so organic. I mean, I've installed solar panels in my home 10 years ago. It's a tremendous technology, and it's no moving parts. It's just a matter of time. It's just a question of one administration might accelerate. It was probably more of a Trump administration might push back on it versus a Harris administration might add fuel. But overall, it's coming. I mean, just the ability to store with batteries, the ability to generate electricity, to use electricity rather than petroleum is just overwhelming. And also another book on that was Price of Time, which pointed out the deflationary forces out of China. So to me, only if Trump's elected, otherwise it shouldn't be much different from a commodity standpoint.
Vince, I want to get your read on that as well. What's your sense? Does the U.S. actually produce more oil and gas depending on who wins the presidency, or is it just sort of is it an independent equation in your perspective?
I remember during the Obama administration, prior to his election, naysayers in the industry suggested that he would be a doomsday for oil and gas production. Yet we hit new highs on both. So, look, I think it is very organic. I think we need all sources of energy. I've said this before. The more solar and wind that come into the mix in the power sector, the more we will need natural gas storage. One is an intermittent source. The other is a permanent source that's on 24/7. So I think that from an organic perspective, once we have more established discipline, stronger, bigger companies, fewer companies managing the production process, I think what you're going to have is less volatility, not more volatility. And I think Mike and I remember those days when you had, double digits on natural gas. If natural gas hits $4, we're out there partying now from below $2. So, volatility has shifted. And for those of us who remember the extreme volatility where natural disaster has really moved the needle, this time around, it doesn't seem as volatile, and it doesn't seem as violent. So I think going forward here, I think it is more organic. And while administrations do have impacts on the margin, free market does drive much, if not all, the debate.
Thank you, Vince. For anyone who hasn't seen our research on First Solar, we do think there's a meaningful impact for some of the profit outlook or the companies that are manufacturing clean energy equipment in the US, particularly if the IRA goes away. So right now, First Solar is running at a 45-50% gross margin. That probably falls in half, more like 20-25% without the tax incentives that are available. Now, as Alessio already alluded, our sense of working with our colleagues in Washington, D.C., Nathan Dean, and some of those others is that even if Trump wins in November, the idea of IRA repeal is probably not going to be the first priority on his list of things he wants to get done. Alessio, I want to come over to you for just one. Actually, I think we lost Alessio. He must have had to jump. I was going to give him final word, but I'll take the final word and we'll leave it there. So Mike, Vince, great to speak to you. And I hope everyone has a great remainder of their week. Reminder, we hold these calls every Wednesday. If you've got questions, topics, or potential guests that we should have on, just let us know and we'll aim to involve you in the conversation and talk about things that you want to hear instead of things that we necessarily want to tell you. So hope everyone has a great rest of their week and we look forward to being in touch. Take care, everyone.